This is Michael King, and today we're going to talk about market multiples and precedent transactions. We're going to look at how relative valuation is one of the techniques for coming up with an implied valuation for a company's stock. We're going to look at two types of relative valuation: market multiples of comparable companies and precedent transactions from different mergers and takeovers. We're going to look at the steps for choosing comparables and which multiples to use. We'll look at a couple of examples and the interpretation of both the price to earnings and EV to EBITDA multiples using Apple Inc. And we'll look at how to generate that implied valuation. Relative valuation is one of three different techniques, of which the others are cash flow valuations, such as discounted cash flow, and asset-based valuations. Relative valuation using market multiples, like the others, is more of an art than a science. The most difficult part is how to identify the comparable companies, or the comps, particularly when you're dealing with a company that may be private, has multiple divisions, or has no known competitors. Multiples are subject to irrational investor sentiment. At times when the market is high, all multiples may be high, but that may not be a good indication of the intrinsic or fundamental value of a company. There are also points in the business cycle when multiples may be either higher or lower. Multiples can also be sensitive to things such as outliers, as well as accounting choices such as non-recurring items or extraordinary items. They can't be used when a company has little or no earnings, and they are sensitive to capital structure choices when looking at price to earnings and other price multiples. Finally, multiples do not tell you anything about the fundamental business of the company, its strengths, weaknesses, opportunities, or threats. So market multiples will use the current market price, which means they're up to date and reflect where the market is today. Market multiples do not incorporate a control premium, meaning they are the price for a single share and not for majority or significant control of a company. They could be backward-looking, in which case we talk about last 12 months, or forward-looking, in which case we will talk about next 12 months. They're typically using consensus earning forecasts, and they do provide a relative, not an intrinsic or fundamental value for the company. Precedent transactions are based on mergers and acquisitions that happened at a given point in the past. They are the multiples that were actually paid, based on the last 12 months, and they do not include the synergies that might have been part of that transaction. They are affected by market conditions and waves, so after a series of mergers in a given industry, the multiples will become higher. They incorporate a control premium. They typically are going to be 20% or more higher than a market multiple for a given transaction. Precedent transactions will vary depending on what type of buyer. You could have a strategic buyer, such as a comparable company in the same industry, either vertical or horizontal. Or you could have multiples where the buyer is a financial buyer, also known as a financial sponsor, such as a private equity firm. Multiples are also related to the form of payment. A cash offer will typically be higher than an offer for shares, where the recipients of the shares are going to benefit in the upside following the transaction. When looking at precedent transactions, you will also be using fully diluted shares outstanding. Here's an example out of Rosenbaum & Pearl's Investment Banking second edition of what a sheet may look like, showing the market multiples. In this case, for a chemical company using both specialty chemicals, commodity or diversified chemicals, and small cap chemicals. You can see a range of multiples for enterprise value and price, EV to sales, EV to EBITDA, and EV to EBIT, with last 12 months as well as two forward-looking multiples. You'll also see a price to earnings for the last 12 months, next 12 months, and another forward period. And you also see comparisons based on the size of the firm, based on enterprise value, the margins, the leverage using debt to EBITDA, as well as the growth of the firm, here shown with EPS growth. Precedent transactions, as shown here, are takeovers or mergers that happened in the past. In this case, we can see a series of transactions spanning from 2010 to 2012, where the acquirer and the target are listed. The form of consideration could be cash or stock, and you can see that the deals took place at different multiples of enterprise value with different premiums relative to where the shares were trading. In some cases, the targets may have been private, in which case there was no premium that could be measured. You can see here that the best way to use these precedent transactions is to calculate the mean and the median for the most relevant transactions, and using that to generate a range of multiples, which, when applied to the company's financial metrics, can give you their implied enterprise value. You can get reports on multiples paid in M&A transactions by industry and year, such as this report from Thomson Reuters. You can see here that for transactions all around the world, the multiples paid ranged from a low of around 11.8 times to a high of 20 times based on different industries. So what are the steps you need to follow? You need to find the universe of comparable companies and then narrow it down to find the most relevant peers. You're going to have to look for the financial information for those peer companies or comps using data filed with regulators, data providers such as Bloomberg, Capital IQ, or other sources. Or you may want to look at equity analyst reports or investor relations reports filed by the company. You're going to take the data and calculate key financial statistics, ratios, and multiples in Excel, which is known as spreading the data. You're going to want to use the last 12 months financial data for your company if it's not the end of a fiscal year, and you're going to need to make adjustments to accounting numbers as needed. You then would calculate sales, earnings growth, margins, profitability, and leverage in order to see which companies are most relevant. You'll calculate the mean and the median of those ratios and multiples to see if they are close to each other, and this may lead you to identify and remove outliers such that the mean and the median do become close to each other. Based on that range of mean and median, you can then calculate an implied valuation. So let's take a look. Here we can see that the first step is really the critical step, looking at which companies are comps. You want to look at both similar industry as well as financial profile using the data here. As we can see in the case below, the tier that was chosen was specialty chemicals, and it's good to have 3 to 5 comparables when calculating these averages. As you can see, looking across the range of enterprise value multiples, the mean and the median are very close or on top of each other, suggesting that there is not a problem of outliers. Now, which multiples you use is dependent on the target and also its capital structure. The equity multiples that are available are price to earnings, price to book, also called market to book, price to sales, and price to cash flow. The enterprise multiples, which look at the value of the full firm, not just the equity, are enterprise values to sales, to EBITDA, and to EBIT. Enterprise value multiples tend to be the ones most commonly used in valuation because they are not sensitive to capital structure choices. When data is not available on depreciation and amortization, or the firm has high capex, we may use a multiple of EV to EBIT. Equity multiples can be skewed by capital structure, particularly if the firm is highly leveraged. They are also skewed when the firm has small or negative EPS, in which case they may blow up or they may be not meaningful. Enterprise value multiples do not suffer from this problem. Now, looking at multiples of sales tends to be less relevant than looking further down at either EBITDA or at net income or earnings per share. Just because a firm has high sales does not mean it's going to be profitable. You should also consider whether there are any specific multiples for your industry that could be useful, such as oil reserves for an energy firm. The choice of multiples, therefore, matters most when leverage is varying across firms, there are differences in capex and depreciation, and when there are apparently outliers in your data. Again, from Rosenbaum and Pearl, here's just a reminder of how you would calculate equity value and how you would calculate enterprise value. For equity value, notice that you're going to use fully diluted shares outstanding, which is going to be basic shares plus in-the-money options and warrants and in-the-money convertible securities. For enterprise value, we're going to take equity value, add total debt, add preferred stock and non-controlling interest, and subtract cash and cash equivalents. Let's take a look at the two most common multiples you'll come across, price to earnings and EV to EBITDA. You can think of price to earnings as a form of payback, where earnings per share is the annual payback. The price in the numerator is the value of one common share where it is trading today. Earnings per share is last 12 months, and it is the earnings that will be paid out or belong to a common shareholder. Notice that EPS only measures earnings in 1 year, either the last 12 months or the next 12 months. For this reason, it gives you a number that tells you how many years of earnings, given no change, it would take to recover the cost that you pay. If you pay $20 for a stock and its earnings per share is $1.33, that gives you a P multiple of 15. So you can think of this as a payback of 15 years. A typical P multiple for an S&P 500 company is between 15 to 18 times earnings. For EV to EBITDA, we see that enterprise value is a measure of the market value of the assets. EBITDA is a proxy for free cash flow. EBITDA is used because it tends to be a proxy for the cash available to distribute to all capital providers, both debt and equity. If a firm has an enterprise value of $1,000, an EBITDA of 125, its EV to EBITDA multiple is 8 times. A typical range for an EV to EBITDA multiple is 5 to 10 times. Firms that have higher than that tend to be high growth or very profitable firms, such as technology, and firms that are lower than that tend to be very slow growth and mature firms with low margins. Once you have your market multiples, you want to pick the comparables that are closest and find a range. You do not necessarily want to use from high to low or the maximum points of the range. You want to look at something like the median or the mean to come up with a fair value for the company towards the middle of your range. Let's take a look at Apple. Here we can see data for Apple for the last 3 fiscal years plus the last 12 months calculated as of the second quarter of 2020. You can see the shares outstanding have been declining as Apple has been buying back shares, and at the same time the share price has been appreciating. The market capitalization has increased from $790 billion to over $1 trillion. Apple has no preferred shares and non-controlling interest, and it does have debt of around $110 billion, but that can be offset by its massive cash reserves of over $200 billion. You can see that its enterprise value is the market capitalization of equity, adding preferred, non-controlling interest and debt, and subtracting cash. You can see that Apple's PE multiple over the last 12 months has increased from 16.7 to 19.2. When it comes to EBITDA, you can see that its enterprise value to EBITDA multiple has increased from 8.9 to 12.8. Here you can see we're comparing Apple to Microsoft, Alphabet, which is the parent of Google, and Facebook. This data is as of 1st of June 2020. We see the last 12 months and the next 12 months multiples for PE, market to book, price to sales, and EV to EBITDA. Notice that we have the average and the median, and that there is no apparent outliers. When looking at Apple relative to the average and the median, you can see that it appears to be undervalued based on the price to earnings and price to sales, slightly overvalued on the basis of market to book, but fairly valued based on enterprise value to EBITDA. This example shows how difficult it can be to interpret relative valuation, particularly when multiples are sending different signals. Given that some are higher, some are lower, and some are in the middle, we would say that Apple is fairly valued. Once you have a range of multiples for a company, you can use that information to generate its implied equity value. Looking at the PE multiples, for the last 12 months, we see a range of 13 to 16 times. The earnings or net income, in this case, was $70 million. This would give us an implied equity value of $910 million to $1.1 billion. Based on 100 million fully diluted shares outstanding, the implied share price would be $9.10 to $11.20. The multiples decrease as you go forward in time. The multiples for 2012 are lower than the multiples for the last 12 months, and 2013 are lower than 2012. You can see that the financial metric, in this case net income, is increasing over time. In the lower half, we see a similar exercise for EV to EBITDA. Notice that the multiple ranges start at 7 to 8 for the last 12 months, declining to 6 to 7 for 2 years forward, and they also generate an implied share price range that goes from around $9 to $11. Armed with the results of these multiples, we create what is called a football field, where we look at the range of valuation for our company based on the different multiples. Notice that we're looking for an overlap between the valuation implied by the different multiples. This overlap is not going to give us a point estimate, it is going to give us a range of fair value for the company. Good luck using multiples, and be careful of how you use relative valuation.